My name is Jeff Clark. I'm with GoldenCare USA. I want to, first of all, just thank everyone for coming on board. It's nice to just take a little time and maybe learn a couple of things about the products we offer. GoldenCare tries to do, some regular product training, 2 or 3 webinars a week. But do know that we do record all of the trainings. And, we have different personalities, different regional directors do the different product trainings between Tom Randall, John Randall, Jen Felton, and myself, Jeff Clark. We all do the different topics. We record them all. It's always nice to hear a different, version or a different opinion on the same policy. Sometimes different writers are covered differently. So I do encourage you to go onto our library there at goldencareagent.com and look at some of the pre-recording trainings we've got there. I think it's under the tools resource area there. You'll see all the pre-recorded trainings. So anyways, this is a presentation that we put together kind of midway through last year, and really the premise behind it, and let me just say again, I am Jeff Clark, the GoldenCare USA. I've been here for 21 years. I spent my first 6 years in the field. The next 15 years I've been in this director position, where essentially my job is to compare and contrast and understand the different products in the long-term care industry, offer some advice to my brokers out there as far as what plan I think is best. So I continually break down price and strategize, and I do still sell long-term care. I keep my certifications, both Medicare and long-term care. I keep them going. I sell, I probably sold 10, 12 long-term care policies last year, and so I've written over 700 policies, so I come at this with kind of a fellow agent perspective. I did more selling last year. We had some internet leads I was working, and just to kind of sample them, so I ended up doing more selling than I have in the past, and I'm really running across LTC hybrids, life and long-term care hybrids, a lot. Matter of fact, doing some research on it, 10, 12 years ago, it was 3 long-term care policies written for every 1 hybrid, and now it's switched around the other way around, where there's 5 hybrids written for every 1 long-term care. It's so really, I run into these things, and just selling, I just kept bumping into them, so I really started breaking them down, comparing and contrasting different plans out there. Your One Americas and your Lincoln Financials and your Pacific Lifes and your Securian Life, and et cetera. And so, to the better understanding, I kind of found a way to kind of compete with them, compare them, if you will. There's definitely a time and a place for them. But to start out, let me just, the first couple slides I have, I get a lot of agents ask me, they price long-term care, they send a quote out, they never hear back from folks. And I think it's because people are just quoting too much coverage. So I'm going to just take 2 or 3 minutes here before I go into the hybrid comparison, and just talk about, just better ways of designing plans to keep prices down to begin with. If you want to compete with hybrids, we've got to start kind of learning how to write a certain amount of coverage that's affordable, that can still do the job. It really plays well when you start comparing the hybrids. But so I used to do this back even 15 years ago when I teach agents, the long, skinny versus short and fat. I'm a big believer in short and fat. Take a look at this comparison, for example. Now, this is what a lot of people do. They'll write a $4,500 a month benefit. It's a typical plan that I see agents will come out and design. They don't do much long-term care, but they come out and they want to design one. They get a client that asks them for it. Maybe they have a med sup background, financial planning background, what have you. They don't do long-term care. So they think, well, the local costs are $5,000. We're going to write $4,500 a month. They could be in there for 5 years. We'll do 100% assisted living. We're going to put 5% compound on there. And we'll do, the policy maximum, of course, is $270,000. That's what gives you 5 years. So the premium for a 60-year-old couple here, $9,000. You're just not selling much if you quote this. So first of all, right at the start, this is the incorrect way to sell long-term care. This is just, you just can't design it this way. You need to go shorter, fatter, and lower inflation. So just take a look at this. So I have the software up. If I actually can maybe, a little small. I'm going to show you the software. This is the 9216 here. Okay? So all I'm going to do with this is I'm going to take this. I'm going to keep the pot of money at $270,000. But I'm going to increase this. I believe I went up to as high as $7,500. Yeah. So I'm going to go $250 a day instead of $150 a day, or $7,500. Okay. I'm going to take this inflation down to 3%. 3% growth on $7,500 is $2.50. A growth. 5% of $150 is $2.50. So your growth is very similar. 5% will catch and pass eventually at some point. Some 30. I'll show you this. 30 years, 40 years down the road. So, and then here, since I've increased the monthly benefit, I'm going to take the assisted living back to 50%. Assisted living, which Assisted living facilities only charge 56% of what nursing homes nationwide do to begin with because it's assisted living. So 50% of the 7,500 gives them equal to what they had before. So I've restructured this now. I have taken nothing away from the client. I kept that pot of money at $270,000. I increased their monthly and lowered their inflation. So you take a look at that over here. Now the premium, of course, I cut that premium in half. Didn't offer them really any. As a matter of fact, I improved their benefits. Why? Because right now, if they go on claim with the other model, they got a $4,500 a month benefit. If they have a stroke tomorrow, 61 years old. With the other way of doing it, you're going to have $7,500 to begin with. Now that can cross over, like I mentioned. 10 years out, this is paying $73,000 versus $10,000. In 20 years, average claim happens at 81. So 20 years, this is likely their claim time. $11,000 versus $13,500. Now this does cross over somewhere in the 26th, 28th year. You do see that this will cross over. So you can change this a little bit to maybe put a little bit more even on the 7,500 so it crosses over even later if they have longevity in their family. But as you can see here, I've cut these premiums by doing nothing but just restructuring this into a more shorter, fatter, better design. Okay, just something to point out. But either way, $5,000, still a tough premium to get people to buy. So let's just talk about price sensitive real quick, and I'll go into my comparison of hybrids. So just my advice to people when you're quoting folks. We have to start with a small little package. We need to give them something to show them that long-term care is affordable. In other words, I put in parentheses, don't scare them away, right? So we got to start out with a little amount. In other words, I remember there's a slide in our PowerPoint. It talks about, you can get a Volkswagen or Cadillac. You can get coverage for as little as $40 a month. You can get coverage for $500 a month. I used to ask my clients, can you afford $40 a month? They'd say yes. Can you afford $500 a month? They'd say no. I'd say, can you afford something in between there? And they would kind of agree. The point is here is, so what I'm going to do is I'm going to start with something that's very affordable. I want to bite. I just want to get them to look at it. So I'm going to start out with $3,000 a month benefit. I'm going to bring the software back up again. So, this couple, I might just start out with $3,000, and I might go to a benefit pool, say maybe, I don't know, $100,000, $75,000 to start, okay? I might even take the inflation out of there, okay? So at this little rate here now, let's, 75,000, maybe non-inflation. Now I'm going to show them a monthly premium here is $36 and $52. I'm not going to sell them that, but I told them it's affordable. So if I were to put some inflation back in there, we get 3%. So let's do lifetime here again. Now it's partnership qualified. Well, now we're talking about $68 and $104. Now from here, I usually like to then show them $4,000 and $100,000, and maybe 1% or 2% inflation. So in other words, here's your base. Here's where you start, kind of like, hey, look, I can afford $68. Well, then I tell look, to make it more, make sense, you might want to go with $4,000, and then we can maybe put a little inflation on there. Sure, it's not going to qualify for partnership, but you can buy up later with mutual product. I won't go into product, but you have the ability to increase it to 2, 3, 4, or 5 any time in the next 15, 20 years, so free of underwriting. So anyways, I can get them to an inflation-based policy, $4,000 and $100,000 pot of money for $64.91 for $156 total. So this kind of gets rid of, is it affordable? And I promise you, if you start out with this lower strategy, you'll make more sales. Work up from there. Okay, so enough about, designing them. How are we going to compete with these hybrids? And so, like I mentioned before, I went into this thing, and I started running into hybrids all over the place, and I just, for the life of me, I can't figure out why so many people are writing so many hybrids. I do know that they're easy. I do know that it's convenient. I do know that sometimes you have a client that may have some old annuity money sitting around, or some life insurance contract, or they got dead money laying around. And so maybe they want to go ahead and just, an old life contract, they're going to roll it into a new life contract. Or maybe they've got an old annuity, they want to roll it into one of these, nursing home type annuities. But, in other words, they're going to pay penalty on it, they have to cash out. There are certain situations that the hybrids are a good, matter of fact, probably the best fit. But I think they're being way overused. And here's why. If you're just looking at long-term care, okay, I want to solve I understand that I need to buy long-term care. But, those premiums can be expensive, and they can go up. They could have price increases. I could pay this whole life. I could die in my sleep. I could never use it. And so the hybrid looks appealing. If I buy this, whether if I use long-term care or if I die in my sleep, I'm going to get a death benefit or I'm going to get I'm going to get paid either way. And you know what? The rates are guaranteed, so it can't change. Sounds great. Okay? All the troubles that long-term care's had. First of all, I want to just kind of dispel a myth of the rate increases. Long-term care policies are priced with such a with a low interest rate environment. They're priced with much lower interest assumptions. The price for long-term care has tripled in the last 5-10 years if you've been paying attention. So the prices we have now are much safer. Matter of fact, carriers have actually lowered the price in some of the new blocks coming out. And so we're not seeing the need for these rate increases. And if you look at, I got research on this, articles, stats, the chances of the newer policies needing rate increases is less than 5% now across the industry, where the ones that were written 15 years ago and badly underpriced, naturally they had to be fixed. So the industry's corrected this bad pricing. But either way, people are still worried about rate increases, and I understand that. Okay. So because of this, they're really overpaying and buying a really poor policy or poor strategy because of their fear of rate increases and because they think they're going to use it or lose it. So let me show you something that I came across that I think is eye-opening. I ran hybrid A and B here. Now, these are just two companies out there. They're very popular ones in the industry. I don't want to go bashing carriers because remember, we sell hybrids here. There's nothing wrong with hybrids. In certain situations, they work out. My point here is that we're overusing them. So this is hybrid A, hybrid B. Okay? And what I did here is I did a $125,000 death benefit. And if you know anything about hybrids, what they do is they pay 4% of your death benefit. Okay? Almost all of them across the board do. All right? It's kind of an accelerated life benefit, so you get 4% of your death benefit until it's gone. So 4% of 125 is a $5,000 a month benefit. That would last for 25 months because that's how hybrids are. As soon as your death benefit is exhausted, well, okay. So this means that I get $125,000 death benefit, but I also get $125,000 long-term care benefit, one or the other. Okay? So the premium for the hybrid A is $5,000. Hybrid B is $4,200. Okay, so what I did here is I ran a long-term care plan. All right? And what I did is I just ran the premium of $125,000 death benefit and a $5,000 monthly benefit. I don't have to keep going back to the software for you, but that's all I did here is I'm just running $125,000, and I'm going to put that same $5,000 death benefit in there. What do we say we have a 60-year-old couple here, 55 and okay, so 55 and 50. All right. The annual on this. What else did I do this thing? Now we did. $1,330 a year. So I must have had the inflation at none. Yeah, there's no inflation in this policy because the hybrids don't pay any. And it's just 100%. Okay, there it is, $1,330, right? So this is a 55 and 50-year-old couple. The annual premium for the same benefit they're getting in a hybrid, because remember, if it's a hybrid, they're going to get $100,000, $125,000 death benefit or $5,000 a month for long-term care until it's gone. So I'm giving the same thing. I'm giving a $125,000 benefit, and I'm giving a $5,000 monthly benefit. The premium for that is $1,330 a year. Now, what if I don't use this and I die in my sleep? And well, what I'm going to do is I'm going to write a second-to-die life policy for this husband and wife that upon their deaths, they're going to get $125,000. No questions asked. This takes care of what if I pay my premiums of $1,300 a year for 30 years, I've paid $30,000 or $40,000, you're going to get all your premium back and then some. And if there's rate increases, you have room for a doubling of 100% rate increase. You're still getting it all back. All right, so that takes the rate increase thing out of the thing. It takes what if I don't use it out of the window. My total for this, $2,400 versus $5,000. I can do this with I can put inflations because remember, hybrid. This one here doesn't have any inflation. That benefit's not growing. I can do this with 3% compound. Now that premium, instead of being $1,330, if I go over here, again, I just put the inflation on this thing, which you should for that age bracket, right? Should have some inflation with your benefit, otherwise it's no good. There we go. Okay, so now it's $2,866. There's that premium there. I had the same second-to-die life for it, right, the $125,000. I end up $4,032. I'm still under both hybrids. Look how this spells out. This is, again, I'm blown away by this. So, with hybrid A, I get a premium of $5,000. I get a monthly benefit, if I need long-term care, of $5,000 a month. Or, If I die, I get $125,000, so I get something no matter what. Great. Okay, you're right, you do. But it is either or. You don't get both. You get either or for $5,000. Down here for half the premium, I get a $5,000 a month benefit just like the hybrid. But I also get a $125,000 benefit for death. And I can get $125,000 for life. So if I use $125,000 LTC benefit, I still get my $125,000 death benefit. I get twice the benefits for half the premium. I just don't, for the life of me, understand why so many people are flocking to hybrids. I can do that, so I did this in our company. I did the same thing here. Okay, on this one here, $4,200. It's still $2,400. It's much under that. And so then I went ahead and ran out with that 3% compound. Now this is where it really, really starts to get to me how many hybrids are written out there. Look at this. So with that 3% compounding inflation benefit, 55 and 50-year-old female, the benefits are going to come 30 years later. Okay, that's the average claim I mentioned earlier is between 80 and 85. So okay, in that 30 years, your $5,000 a month benefit is now raised to $12,039. Your LTC pot of money is now $303,000. Oh, and by the way, you still have that $125,000 death. It's not going away. It's staying there. It's already done. So now, for the same premium here, actually for less premium, $5,000 or $4,000. Again, I can put all kinds of hybrids in here. I'll blow all of them. Same theory. It'll blow all of them away. Doesn't matter who you go with here. Look at this premium. It's $4,000. If I'm going to spend $4,000, come claim time, do I want to have a $5,000 a month benefit or a $12,000 a month benefit? Do I want to have a pot of money of $303,000 or $125,000? And if I use my long-term care, any or all of it, do I still want to have a $125,000 death? If I happen to use it up, I don't get that death benefit? Of course I do. So I'm talking about $425,000 worth of benefit versus $125,000. 3 to 4 times as much benefit for the same premium. Why? Now, I do see that people, you'd have to apply a couple with 2 applications. In other words, they'd have to apply for life, and then they'd have to apply for long-term care. And so maybe agents give them the benefit out. Maybe it's just, having 2 sets of paperwork to do, 2 sets of interviews. Maybe it's too much for a client to endure. And if they're just wanting to look at a hybrid, I don't want to fight them on it. I don't want to lose a sale because if their mind is telling them they want to buy a hybrid. So I understand all of that. I completely do. I have clients that come to me, and I'm the expert, and they're asking me, what's the best way to go about solving this long-term care plan? Now, I'm a traditionalist, I guess. I've been selling long-term care for 21 years. I do believe in the product, so I own it myself. I don't think there's a better way to solve the long-term care need than long-term care itself. But if you're worried about getting money back, if you're worried about losing premium dollars, dying in your sleep and never using it, or if you're worried about rate increases, then just sell them a little life policy along with it. Honestly, you'd go into software. And I could just add this 3 times monthly benefit, okay? So right now I had this benefit set at $5,000. If that little rider there puts $300 annually, $10 a month each, what I'm getting now is $15,000 death benefit on top of my long-term care. Now my total is $3,100, and I'm getting $30,000 back. If your premium was only, what was the premium here? $28 a year, $24 a year. That's 20 years worth, 10 years worth of premiums right there, or so for the 2 of them. If you're getting $30,000 each, you're getting $15,000 each. That's $30,000. That builds in about 15 years worth of return premium rider for very little cost. They're just okay. So, by the way, this works. Let me show you one more example. I'll go to questions. This is now I did the same thing with a 65 and 60-year-old couple. Okay, so a little bit older, same thing spells out. Now the premiums, of course, are more money, $7,000 and $8,000 for the 2 hybrids I used. Now my long-term care premium is $2,200. My second to die is $1,800. So that totals $4,000. Still beats the heck out of $76. And $5,800 with inflation still beats the heck out of that and that. Okay? And look at the benefits. Same thing here. Again, we have less time to grow. We have 20 years to claim, but instead of having a $5,000 a month benefit or a death benefit, either or, you can't have them both. I now have $225,000. I have a $9,000 benefit instead of $5,000. I have a $125,000 death benefit on top of the $225,000. So I've got $350,000 of the benefit versus the $125,000. Again, 3 times the benefit, double the monthly benefit, half the premium. Here's the thing. I'm going to wrap it up with this. this is not meant to be disparaging on the hybrids. I'm just trying to ask people and make them look a little bit further as to how you're solving the problem for the client. You know, I guess what I worry is, the thing I talked about earlier, 5-to-1 hybrids, one way or the other. Our long-term care industry, and a lot of us, you know, do a lot of long-term care. We are a long-term care specialist. We are dying on the vine as long-term care sales. And unfortunately, so many agents are flocking to hybrids, they're looking past probably a better solution here. And it's traditional long-term care all along has been there. And if you're worried, the rates are more stable now to begin with, but if you are worried about it, then just sell them a little. It doesn't even have to be a second to die. It can be a first to die. That way the wife can pay off all the bills and have a paid-up policy. You know, you can do a joint or a survivorship in the policy so it's paid up. So now you have to pay any more premiums or worry about rate increases. You know, you go back to software here, you put that survivorship on there, for example. Now you got a paid-up policy regardless. So there's so many ways to do this, and I'm just trying to open your eyes to saying, wow, maybe I should be offering my client. Maybe you have a client you just lost a hybrid to. I'd bring them up and say, you know, I just want to talk to you about something. I think I can cut your premiums in half for the next 30 years. How would you like to save $100,000 and have 3 times the benefit you currently have? Let us help you do that. If you know of a hybrid you just lost, if you know some clients that are agonizing back and forth, if you need some research on the fact that rate increases are pretty strong, if you want me to run some rates for you and do rates for you, Jen here, Tom, all of us can help you. I'm going to put my 800 number on here, okay, right here at the top. Give us a call if you have any questions, 800-842-7799. If you did attend today, I believe Lynn will send you a copy of this PowerPoint, along with some other stuff. Otherwise, give me a call. I'd love to talk to you further about this. You have some cases to compare or contrast. I want to thank you for coming on board today, as usual. We appreciate the time you spend with us, and good luck selling out there, okay, folks?